Greetings and welcome to the afternoon session. I would like to take this time now to introduce our next speaker, Jackie Khor. Jackie Khor is Associate Director and Manager of the Rockefeller Foundation's Program Venture Experiment, also known as ProVenEx. ProVenEx is an investment fund within the foundation that extends loan guarantees and makes program-related and private equity investments to catalyze private sector capital into underserved sectors and geographies. Jackie is responsible for making and managing ProVenEx investments and private sector partnerships in the following sectors that reflect the foundation's thematic programs: agriculture in sub-Saharan Africa, global public health, inner-city employment, and community development in the United States. Prior to joining the Rockefeller Foundation, Jackie was director of the New York City Partnerships Employment Program. She was previously a vice president in Lehman Brothers Public Finance Investment Banking Unit in New York and San Francisco, and she also worked in mergers and acquisitions, consulting to the insurance industry. Without further introduction, please welcome Jackie Khor.
Hi, everyone. My job here this afternoon, after lunch, and after one of my heroes, Maria Otero, is to give you a crash course on the full spectrum of what we're calling social impact investing products and strategies that institutions, including foundations and corporations, and individuals such as yourselves and I, could invest in a better way to align our investments with our social values or philanthropic mission. My subtitle, Capitalism for the 21st Century, is intended to be a bit of a provocative question. Right now, the field is just beginning to register in the mainstream. There's a lot of skeptics. Rightly so, actually. A lot more analysis and re-examination of fundamental investment tenets are needed before this field of social impact investing can really be viable. And a lot more analysis of the social impact that these strategies could actually deliver would also need to be made. So I will begin by first presenting the spectrum, a full spectrum of social investing instruments that are available to both individuals and institutions, depending on your risk appetite and depending on whether you're willing to accept lower risk-adjusted rates of return, although that is not necessarily always going to have to be the case, and depending on what sectors your social objectives align with. Walking through the spectrum, starting with the green side on the, well, it's on the right-hand side, your right, are sort of more market rate investment opportunities, beginning with public equities, which is basically the ability to buy shares in publicly traded companies, largely through screened mutual funds, which I'll describe a little bit later. Private equity is basically venture capital types of investments directly into the shares of privately held companies. Fixed income is basically bonds, fixed income instruments that allow an investor to receive a fixed interest payment and a date certain upon which your principal will be repaid. Cash is fairly self-explanatory. Guarantee mechanisms, for those of you who were here when Maria was speaking, Maria spoke about this potential for the guarantee mechanism to be used, which at Action International, I believe, if I recall correctly, their guarantee bridge fund leveraged over 10 times capital from banks and other financial institutions. And this is the ability for institutions with creditworthiness, Google, Rockefeller, Action International, to lend your blue chip creditworthiness to allow other institutions to access capital, often at lower interest rates, at lower cost of capitals, and especially for sectors that wouldn't otherwise have access to capital to be able to receive capital from the banking sector and the private capital markets. Moving down through the spectrum, I'm now on the blue side, are really sort of the instruments that are generally associated with below market investments. And within this category are what is known as program-related investments. These are investment strategies, investment tools that foundations, private charitable foundations, are allowed to use by the IRS that allows them to make investments, structure them with a financial return component. Usually, as I said, the return is below market. And this particular tool is most often used in underserved sectors or geographies when it is important and imperative to bring in the private capital markets. And microfinance is one of the early examples of that. U.S. community development sector is also another area, and actually in my presentation, I'm going to be drawing from examples not only from microfinance, but also more locally from community development and enterprise entrepreneurship development here in the United States as well. On the far left-hand side, I put in that spectrum of social investing instruments, the grant-making instrument. As Maria alluded to, grants are a very precious resource, and I don't want this discussion about social impact investing to cloud or to make us forget the importance of grant-making, especially when you want to build enduring institutions in the not-for-profit sector, because that is really the only source of capital that not-for-profits have to be able to build and grow. And as Maria mentioned, institutions that are now household names today, like Ramin, like BRAC, like Action, were basically built by good old-fashioned grants that were given to them by individuals and by institutions and foundations. The field of socially responsible investing is actually one of the elements of the social impact investing spectrum that I showed you. It is today in the United States a $2.3 trillion market. That might sound like a lot, but it's only actually 9.4% of the total assets under professional management in the United States. Out of the socially responsible investing universe, social screening, which is what most of you have probably heard about, social screening of some kind accounts for approximately 73% of the socially responsible investing universe. So that's a significant majority of this field is all about positive and negative screening. Shareholder advocacy, i.e. using your proxy voting to be able to either propose or vote on certain social issues, accounts for almost a quarter of this universe. And community investing, which includes investments in community development institutions and also microfinance institutions, is a very tiny slice of this universe. As you can see, it's about 1%. And I want to highlight a couple of statistics that came out from the Social Investment Forum Foundation's recent report on socially responsible investing trends. Over the past decade, socially responsible investing assets have grown by about 258%. Versus 250% for growth of the broader professionally managed asset market. So it's grown at slightly higher rate than the growth of professionally managed assets in the United States. And that could be promising opportunities. In the public equities area, as you might notice, that a quarter of the socially responsible investing universe is accounted for by shareholder advocacy, and the leading social issues resolutions that were reported by the Social Investment Forum and the Investor Responsibility Research Center, which is the world's leading provider of impartial, independent research on corporate governance and shareholder proxy voting, are in the issue of the areas of political contributions, equal employment, climate change, and global labor standards. So even as one of the most underutilized tools in this area is actually just voting your proxy as a shareholder. And obviously, the more leverage you have is when you have the most number of shares, and usually it's institutional investors, including nonprofits and foundations, that own a significant number of shares of publicly traded companies. By far, the largest segment in the socially responsible investment universe is actually the socially screened separate accounts. This area has grown by about tenfold to $1.5 trillion over the past decade. Almost all of these accounts are held by institutions, primarily public pension funds, nonprofit institutions, and also foundations. A tiny sliver of this, $17.3 billion, is actually in the form of professionally managed personal investment portfolios for individuals. So you as individuals can actually talk to your financial advisor about structuring these socially screened separate accounts with your Charles Schwab broker, your broker at Citigroup Private Client Group, or at Lehman Brothers, some of the representatives here, and talk about the types of asset classes you want to get involved in terms of bonds or equities, and the types of social issues you might want to put your money behind. The socially screened mutual fund sector is usually, even though the numbers are not that large, it's usually the sector that most people hear about because some of the brands associated with these mutual funds, or the money managers managing these mutual funds, are now becoming household names. So mutual funds in this area, their number a little over 200, and they manage about $179 billion in assets. And as an example, in terms of the types of the money managers in this space, it's one of the probably better known names are Domini Social Investments. And the chart I'm going to show shows an example by way of the historical returns over the past 15, 16 years of the Domini Social 400 index compared to the S&P 500. And you can see that the Domini Social Index is the red line, the S&P 500 is the blue line, and especially over recent years, the Domini Social Index has outperformed the S&P 500. And this is an index of investments in screened, publicly traded securities, screened along certain social criteria. Other well-known fund managers in this area include Calvert and Pax World. The Sierra Club also manages or sponsors a socially screened mutual fund along environmental lines. Moving down that spectrum again, and bringing up, just highlighting some examples from the microfinance sector in the area of private equity and debt. And these are, again, as Maria mentioned, the investment of shares and bonds in microfinance institutions. You already heard from Maria about what Acción does. Gil Crawford later on in panel A is going to be talking about Microvest. It's a fund that makes both debt and equity investments in the top 200, the next tier, the 200 largest microfinance institutions globally that serve micro enterprises. And Sam Moss on that same panel will be talking about Grey Ghost Fund, which is basically a fund of funds, another intermediary to aggregate capital into the microfinance sector. I'm now going to highlight some specific examples, not necessarily from microfinance, but more local in the area of social impact investing in the private equity asset class. A local example is one from our own portfolio. It's a venture fund known as Pacific Community Ventures. It invests in businesses that are hiring from or located in low-income communities in California. One of their investments, actually, you guys probably know this investment, is actually an investment in Timbuktu, the very expensive, trendy messenger bag company. I bet a number of you have their bags. Pacific Community Ventures actually recently exited out of that investment, and as part of the deal, as part of their investment, they structured a deal whereby $1 million was given as a bonus to the company's 40 low-income employees. So this is a very good example of how a community development venture capital fund, such as Pacific Community Ventures, basically uses bona fide venture capital techniques in a way that makes sure that the wealth creation is spread out a little bit broader. Other examples of funds, venture funds of this ilk include in the Northeast, another investee of ours, Boston Community Capital. It invests in growth-oriented local businesses that, again, create jobs in disinvested communities and also at the same time build stronger communities in the Northeast. Also in the Northeast, one of our grantees is SJF Ventures. It makes investments both in the environmental sector and in the manufacturing sector in growing companies that are generating innovations in workforce development in the eastern United States. The Enterprise Foundation is a very large, very well-established, not-for-profit entity that invests capital and develops affordable housing to move people up and out of poverty into mainstream American life. And they are a partner of ours on a number of funds, especially in many disinvested cities in the eastern United States. I should also mention, because I know that Rachel asked me to sort of at least give you an idea of what the return potential could be in the sort of the private equity space, both in microfinance and community development, and they can range up to 10 to 15% in terms of IRR. I always like to use this opportunity to provide some advertising to our investees. I know that might be allowed, hopefully. So one of our investees is the Calvert Foundation, and they have a product that you and I as individuals could go out and buy in minimum denominations of $1,000. And these are called Calvert Community Investment Notes. And what Calvert does is allows you and I as individual investors to pick interest rates ranging from 0 to 3%, as I mentioned, in minimum denominations of $1,000. And what they do is they aggregate this capital from you and me and other institutions and channel them to microfinance institutions and community development groups worldwide, including Action International, including Microfinance. So they are another form of an intermediary that has the potential to actually be the Charles Schwab for microfinance and community development, maybe, a sort of a retail intermediary. Another type of fixed income or bond product that is also available to institutions and individuals are what are known as community investment index funds. One such manager is the CRA Fund Advisors. What they do is they, again, aggregate capital and then channel it into economic development loans, affordable housing loans, enterprise development loans in disinvested communities in the United States. And they have a mutual fund, an open-end, no-load mutual fund with a minimum investment of $500,000 and for institutional investors and $2,500 for individual investors. And it also manages separate accounts with a minimum investment of $5 million. As you can see from the chart here, since its inception in 1999, the returns from the CRA Fund Index, again, of community development investments, has matched very closely, in fact, slightly exceeded the Lehman Brothers U.S. Aggregate Bond Index. So over the past 6 years, the return on the CRA fund has been 6.7%, and the return on the Lehman Brothers Aggregate Index has been about 6.6%. These are gross returns. Another very relatively low-risk strategy to deploy capital for social investing is by investing through certificates of deposits in community development banks. And this is a relatively low-risk way. I mean, many of you probably have certificates of deposits with your local bank. And the difference being that a community development bank, which has a mission to channel capital into underinvested communities, to underserved entrepreneurs, would turn around and lend this money into small businesses or affordable housing projects targeting this particular population. And one of the blue chip names in this sector is actually a Chicago-based bank known as Shore Bank that's based in Chicago but also has branches in Detroit and Cleveland. It's a $1 billion bank today. Oh, okay. I mentioned to you if you remember that spectrum on the blue side, foundations have available to them this very important and actually underutilized tool known as program-related investments. And so these are basically investments that foundations could structure, typically structured as loans into microfinance institutions or community development institutions which is often used to leverage more money into a particular underserved sector. So local examples include Lenders for Community Development, which is actually in the microfinance sector. It is based in San Jose, and it is the Bay Area's largest microfinance provider. San Francisco-based Low Income Investment Fund does basically the similar things. It channels capital into not-for-profit intermediaries and developers of affordable housing projects. Taken from our own portfolio, we recently made a program-related investment in a rather innovative real estate development project in San Diego that's sponsored by the Jacobs Center for Neighborhood Innovation. That's actually funded by the Jacobs Family Foundation, which was endowed by Joe Jacobs, the founder of Jacobs Engineering. And what they did was to develop a 155,000 square foot retail and commercial space in a community in San Diego which was largely disinvested. And over the past 5 years, now they have a supermarket. They've created almost 200 new jobs. And actually, the innovation here is as part of this process, they have put together an initial public offering of shares in this project that individuals from this disinvested community could have an opportunity to invest in and therefore potentially participate on the economic upside of this type of project. And you very rarely find that opportunity in terms of, again, wealth creation, providing access to equity upside for local community residents of underserved neighborhoods. And then finally, I just want to highlight a project that a number of foundations like ourselves in New York City have invested in together with New York City, and which could be a model here in the Bay Area because we face similar issues vis-a-vis the shortage of affordable housing. So we, the Ford, the MacArthur, George Soros's foundations have put together a guarantee fund, about $40 million, targeted towards affordable housing in the lowest income communities in New York City, which is going to leverage at least 5 times that amount of capital from banks in New York City. So that's another example of how guarantee mechanisms can be put together by a number of institutions to leverage capital from other sources. Now, moving away from community development microfinance area, I wanted to at least, again, highlight how you can do different types of investments in different sectors, not just necessarily microfinance and community development. One of our investments is actually in a project that's run by the Smithsonian Institution. It's actually an internet download website, but not like iTunes. The kind of music that this website focuses on is actually culturally important music that's important to musicologists. And what this website does is it digitizes this very culturally important archives, and it distributes it via digital downloads. And I would encourage you to take a look at it if any of you are interested in music from developing countries. The website is www.smithsonianglobalsound.org, all one word. Probably one of the more challenging but yet potentially most impactful investments that we've ever made is actually an early investment we made directly in a biopharmaceutical company that's developing a microbicide to protect women against HIV. So we invested in this company about 6 years ago, and today this company's lead product is in the final stages of clinical trials in West Africa. And if successful, there could be a product in the next 12 to 18 months that women could use, that women could control to protect themselves against HIV. So finally, I don't want to be self-serving about our own portfolio, but from the portfolio of our brethren at the Ford Foundation, and it's also another local example. The Ford Foundation, about 2 or 3 years ago, made a loan to Transfer USA. Many of you who buy fair trade products probably recognize this label, especially when you go to Starbucks. So this loan enabled Transfer to expand their marketing and outreach and branding, which obviously creates much more economic opportunities especially for small coffee growers in developing countries. Economic opportunities for small farmers in terms of more stable prices and premium pricing for their products. So I just whizzed through this whole spectrum, but I just want to hone in on a few sort of critical, we're here at google.org, and what are we all about? We're all about trying to connect, at the end of the day, the capital markets to entrepreneurs. That's really what we're all about. So the entrepreneurs I'm highlighting here are a woman farmer in Kenya, a woman entrepreneur who's selling seeds and other agricultural inputs also in Kenya, and what's needed in order to connect them to the $24 trillion in capital under professional management just here in the United States are intermediaries. Intermediaries such as the Calvert Foundation, intermediaries such as Accion, Microvest, Grey Ghost, institutions that you're going to be hearing a lot more from. And what these institutions do is they provide the governance structure, they provide different levels of capital structure that can be leveraged depending on the risk appetite of various types of investors. They provide professional management, analysis, packaging, and administration in a much more efficient format that allows individuals like ourselves to make sure that some of this capital gets channeled in a way that could make a difference in terms of providing economic opportunity to people all over the world. So what really is needed to make social impact investing the capitalism of the 21st century? A lot, actually. I mean, there are, the reason why it's very easy to focus on microfinance, to be honest, is that this is one of the few proven sectors. So in order to work, we want to make sure that investors create social impact and get their money back, right? So it's not just an investment in the guise of a grant. And so there's very few sectors that this is proven. So microfinance, US community development, clean technology, potentially, is also another sector that there are proven models. And as I mentioned, in terms of the types of investment products, There are screened mutual funds that have proven that in the public equity space, depending on what your social goals and what your screening criteria are, you can recoup your capital and get a market rate, a rate of return. So you need intermediaries, you need backable entrepreneurs. So again, let us not forget what Maria said about how long it took to build this sector. It took over 45 years that you've been around, actually, FCR International. And Grameen started in the 60s and 70s. But that's where the opportunity is. A lot of people have spent blood, sweat, and tears, lost a lot of money, and what's left is actually a cadre of institutions that is ready for prime time. And I think that's the potential that we stand here at the cusp of in 2006. But what is also important, again, back to fundamentals, when we talk about the whole spectrum of social impact investing instruments, is the importance of grant making to continue to build those enduring institutions so that you can provide the public goods, such as business management assistance at different levels, to either to micro entrepreneurs or to the intermediaries that need to scale up or are ready for scale up. So just some basics about what socially oriented investors need to do. First of all, obviously, be realistic about the level of financial return and your risk-reward trade-offs. There might not necessarily have to be risk-reward trade-offs. I mean, again, in microfinance and in publicly screened securities, you can see that the track record shows that you can get market rates of return. But really, what it really depends on is what are your social or philanthropic objectives. If your objective can be delivered through a market-based mechanism that already exists, the chances of getting market rates of return are much higher. If it's really a neglected sector such as providing access to health care or drugs for neglected diseases, then the market mechanism still needs to be primed. You probably need to take more risk. You probably need to be a little bit more creative and innovative. And again, that's where the potential is. Finally, just back to sort of what, one of the early things that Maria touched on. At the end of the day, in this world that we're in the 21st century, awash with capitalism, it's not just about investing dollars if you're really trying to make a difference in terms of social impact investing. It also takes investing your brand. And this is more sort of a reminder for those of us in institutions with global brands that this brand has the power to influence and the power to inform. So we should be very thoughtful about how, and quite strategic about how we use this brand. And also, since we're here at Google, in the heart of Silicon Valley, the investment isn't just going to be about dollars, but it's also the power to connect by virtue of technology platforms and the networks, both social networks and sort of physical networks. So let's not just think about that it's all about money, because it isn't. On that last point, I would like to leave you with the timeless words of the English poet John Donne, written almost 400 years ago, which seems particularly appropriate today when we consider how capitalism and globalization are interconnected, but not always for the good. No man is an island entire of itself. Every man is a piece of the continent, a part of the main, and therefore never send to know for whom the bell tolls. It tolls for thee. So in conclusion, I leave it up to you to consider and to possibly playing a role in resolving that question that I left in my subtitle of my presentation. Can social impact investing be a more progressive and a positive approach for capitalism in the 21st century? That power to make that change is in your hands as individuals and as institutions.